again with an old friend uh, and a long-time contributor to the Startup Istanbul and startup communities all over the world. So, hi Dave, how are you?
Good afternoon. How are you guys doing? I guess it's morning for me here. I'm guessing it's evening there.
Yeah, it's 7 p.m. ish.
Okay,
Um,
great.
in
Thanks
this
for having
time
me.
of Yeah, anytime. Thanks for joining us. I know you've been very busy with practical VC, and you've been writing the book, which I'm going to ask about. So those two things are
Okay.
like a mess. Uh, but
Yeah,
before that, for people who doesn't know how you got into the Midas list, how you got a few gangs in your background, do you want to start like how did you turn out from this geek to investor to
sure.
like public
Yeah.
figure that writes and contributes to the startup culture?
Long, crazy journey, I guess. I came out to Silicon Valley kind of right around 89, 90. So been here for probably 30 years. That seems like a really long time now. I started out as a programmer and database developer, application developer. Did that for several years, I guess probably 5 or 6 years at least, and got to work with some interesting companies, Intel and Microsoft, and a few
Yep.
others out here as a consultant anyway. Um, I gradually started doing some consulting as the
Uh,
internet was launching. We built our first internet website, I think around 95 or 94, 95, I'm not sure, and started
right.
building some e-commerce sites also. Anyway, eventually that company turned into a small startup that got acquired in the late 90s for kind of a small amount. That was really my first effort. And then a few years after that, I had the opportunity to join PayPal. This was around 2001. So kind of in the
So
middle
who
of
hired
that
you?
downturn. Yeah.
Who hired you in PayPal?
I got a job working for David Sachs, who is
Uh-huh.
now running Craft Ventures. Actually, David
Mhm.
also started a company called Yammer that was acquired by Microsoft for about $1 billion.
Yeah.
Actually, the person who introduced me to the folks at PayPal was Kevin Hartz, who's the
Ah,
founder of Eventbrite, along with his wife Julia Hartz. Um, so yeah, I guess I
nice.
would say first 5 to 10 years I was a programmer geek, and then the next 5 to 10 years kind of an entrepreneur, and then after
Uh-huh.
that started getting into investing. As I stayed with PayPal for a few years through the IPO and through the
Yeah.
acquisition by eBay, made a little bit of money from the PayPal IPO. That was actually I
Uh-huh.
think one of the very first IPOs that happened after
The dot
uh,
com box.
the initial dot-com crisis.
Uh-huh.
Yeah, and made enough money there to kind of get started investing. So I made investments probably in about, I guess, 15 or so companies over the next four
Yeah.
years. Relatively small budget, just a couple $100,000 that I had.
But this
So a
is
lot
more
of
with,
small checks.
yeah, your own money or your friends or the
That
PayPal
was
mafia ganging up on a deal.
yeah, I was not part of the most high level of the PayPal mafia, but I did get the chance to co-invest with Reed and Peter and some other folks in a few companies. So that was my money, just mostly doing angel investing
Uh-huh.
part time. This was between, I guess, 2004 and 2008.
Uh-huh.
And then I tried to start a VC fund in 2008, right during the middle of the next downturn crisis,
Yeah, exactly. That's what I
which
was going to tell you.
yeah, that was a difficult time to start a fund. I wasn't successful getting that fund off the ground, but I my plan B option was I got to work with Sean Parker and Peter
Yes.
Thiel at Founders Fund in 2008. I think I was probably the only person that was hired in in venture capital in Q4 of 2008. Everything was sort of falling apart at that
Why
point.
do you think that happened? What got like
Well, I
Peter
mean,
is
that
not
was
the most
really
easy person to work with, I guess.
yeah. I mean, I think it was more that the mortgage crisis in the United States caused the global meltdown in a lot of different asset classes. So startups, in 2001, there was really a problem with the startups that were going public not really being real companies, and that was, a bit of a fiasco. In 2008, 8 and 9, the companies themselves were not really the problem. It was more just the capital markets that had frozen up for probably, I guess, about a year and a half. And fortunately for me, Founders Fund had already raised their second fund. I'd already been talking to Sean Parker about working with them. And I knew Peter and some of the other guys from when I had worked with them at PayPal. So I got a chance to join them. I was just managing a fairly small amount of capital, just about $2 or $3 million, which for me was a lot of money. For them, that was only about 1% of the money that they were managing. But that was a really great opportunity. Very, very appreciative for both Sean and Peter to give me that shot. We made about 40 investments over the next couple of years, about 20 investments through a seed stage program that I ran at Founders Fund, and then another 20 investments through a program called the Facebook FB Fund that Founders Fund and Excel were running together.
So that's the precursor to early stage seed investing that you did globally. But did you back then agree that there were a lot of deals outside of US because you were so US focused?
Right.
What made you kind of develop this different investment thesis?
Yeah, I guess, so maybe just a little bit. When I was doing the angel investing, I did probably 13 deals with money that I had in my pocket. I did a few more where I was an advisor for kind of like equity. And basic story was most things don't work, but a few things did work out okay. We got some wins. I guess 3 companies that worked out very well for me: Mint.com, which was acquired by Intuit; SlideShare, which was acquired by LinkedIn; another company called Mashery that was acquired by Intel. So all of those were kind of 100 million plus exits. They're not as big as maybe the unicorns everybody expects these days, but still
nobody knew what a unicorn was before. So.
But for me at the time, I had just made very small investments between 10 to 25K into some of those companies, and we got 10x, maybe in a few cases 15 or 20x back. So that was pretty cool. One of the companies that I got to invest in later that I actually also did through Founders Fund was a company called Twilio. And so I, as an angel investor, I just put 10K into the company between their seed and Series A round. When I was at Founders Fund, I had the good opportunity to be one of the early seed stage investors in Twilio, and we did a $250,000 investment in Twilio. I think it was in November or December of 2008. And at the time, the company was just 3 people: Jeff Lawson and his co-founders, Evan and John. And so that was kind of, not that I would know exactly what was going to happen, but 10 years later, that company's worth $30 billion. The 250K that we invested ended up returning, I think, about $30 or $40 million. So it was kind of crazy, but a couple 100x return on that investment. Well, I guess one of the things that was really interesting about that particular time, 2008 and 9, was the entire market pretty much shut down. A lot of investors stopped investing. The valuation environment was very low. So for me, I felt super lucky in that even though I only had a couple $1 million to invest, which was a tiny budget, we got to invest when hardly anybody else was investing, and so we got to see a lot of deals. Those deals were at very reasonable prices compared to what typically you see today, and there wasn't much competition, so we got into most of the deals that we wanted to. So I think out of the 40 or so investments that we made over maybe about a year and a half period of time, 4 of those turned out to be very large public companies or multi-billion-dollar outcomes. So Twilio, SendGrid, Credit Karma, and Lyft were all big ones. To answer your question about the international stuff, I guess from all my experiences with these investments, usually, even though I'm talking about the ones that worked out, most of the investments didn't work out. And so we looked at diversification and making lots of little bets as kind of the way that we would, hopefully have some success.
Uh-huh.
And at least my opinion was that the global market was just starting to become a big opportunity, and that most investors in the U.S. were still only focused on the U.S. Um,
Not
in
even in
fact,
US.
they were only in fact, they were really only focused on Silicon Valley and then
Yeah,
maybe
50-mile
like
radius,
Boston and New York.
Boston, New York.
Yeah, so there's really a small geography where most of the deals in the U.S. were happening. And so, Y Combinator and Techstars and the other groups were already, out doing a lot of programs, and I was trying to think about how we do competitive strategies. We're
Uh-huh.
like, well, it seems like doing stuff international would be a good way to differentiate. And I had started doing these trips called Geeks on a Plane when I was still at Founders Fund around
Yeah.
2008 and 2009. I guess 2009 was our first trip. Um, and that sort of just became a really interesting way to get to know about startups around the world. And later when I started 500 startups in 2010, we continued to do a lot of those trips around the world. We were typically doing at least 2 or 3 of them every year, and I think that was where I met you on one of those trips to the Middle East.
That's not you, that's Hassan, but that looks look alike.
Yeah. So
2015.
I think overall we probably did about 20 of those trips over the course of maybe
Yeah.
6-7 years, and maybe even more than that. And we got to visit a whole bunch of places. I think we probably went to like 30 or 40 countries around the world over that period of time.
Yeah.
And so a lot of those places we met startups that we got to invest in. We met other
Uh-huh.
VCs. That was also how I met Barack and Detum. And actually, we ended up hiring people from those trips as
Oh, yeah.
well. So a lot of the people that started the international
Um,
plans and programs at 500, we met around the world.
so it's really funny because I think Steve Case started the Rise of the Rest maybe three,
Yeah,
4 years ago, which is,
yeah,
when you look into it, like a large VC
similar.
entity. Yeah, large,
Yeah,
like, have completely missed out, and nobody has done that strategy to focus on the places where it's called. I think it's called the flyover states. Like,
right,
nobody's doing much, and that is a strategy that's not been replicated by many other people. So that was US
right.
only, by US investors only, and it took like, it was maybe 7, 8 years after you launched the international version. Why do you think that's the
Yeah,
case? That concentration of capital? Is it the markets? Is it the networks? What makes it
right.
so, like, super dense?
Well, I think, in the US, you had a lot of the, VC capital emerge primarily on the East Coast hubs out of Boston originally, and on the West Coast out of the Silicon Valley semiconductor industry as far back as really the 50s and 60s.
Yeah, large scale, large scale.
And, you had a lot of universities, Harvard at MIT and others in Boston and Stanford and Berkeley
Yep.
in California. To a lesser extent, a few other places, maybe Seattle as well, and a few others. But still, the concentration of VC firms and companies was really primarily in Northern California and New England. I think now it's shifted a little bit more to New York than Boston, but at the time, Boston um, and Silicon Valley were probably the two places where a lot of
Uh-huh.
capital developed. So, for most of the VC investors, I think it was more just because they were surrounded by a lot of talent. They didn't really look as far
Uh-huh.
away. They didn't have to. I mean, a lot of the talent was very close by. You had super high quality people coming out of places like Stanford and Cal. You had a lot of great companies. Probably at the time, I guess you could look at Intel and Apple, and Microsoft was up in Seattle, but still a lot of the
Yeah.
development was happening in Silicon Valley. Um, I guess Seattle is also an interesting place where there was a lot of innovation happening
Yep.
more recently now with Amazon and Microsoft, but Microsoft
And a lot of
primarily.
smoking happening, grunge happening.
Yeah, that was a little bit later, but
That's
I
super
think when I
cold.
came
Maybe that's
out, Yeah, when I came out in the 90s, I guess, on the West Coast, most of the activity was startup activity was in Silicon Valley, and then you had Microsoft up in Seattle, but they also had a presence here. On the
Yep.
East Coast at that time, it was really Boston more than New York, where a lot of the innovation was happening, and that
Yeah,
continued for a
MIT.
while. Yeah, I think after the financial crisis, sorry, I guess I should say the dot-com crisis, I think that was when New York started to happen a lot more.
Yeah.
Um, some folks there. But it is surprising most of that investment was happening very close to where the investors were. They,
Uh-huh.
typically when they did board meetings, they didn't necessarily want to get on a plane. So,
Oh, yeah. And
um,
I think one funny part in that is a lot of the LPs and VCs were not US focused. We're not, or at least maybe in the last 10 years, are not born or raised in US. Like the government funds, large corporation funds, they actually flocked to where the talent is because the VCs were there. So it also kind of drained a lot of the VC capital, possible VC capital from out of other
yeah,
local places. And then now
yeah,
it's kind of
certainly.
shifting. Do you agree? It's kind of there's a shift. Like LPs are
Well,
investing in their own turf.
yeah, I mean, certainly, the one big change certainly was China, starting in the 90s and then definitely over the last 20 years. China has become a huge venture ecosystem, just on its own.
Uh-huh.
Probably not quite as large as Silicon Valley in the US, but pretty close. And then I would say the European, venture ecosystem has developed a little bit more slowly, but maybe in the last 5 to 10 years has become pretty substantial. And you
Yeah,
see,
some European
some very
IPOs,
large, yeah, some very large companies, Delivery Hero, Deliveroo, and a lot of things in commerce and
Spotify,
travel, right?
Minecraft.
And Spotify, yep, yep, and maybe Skype was another big one.
Absolutely. Skype, I think, is the PayPal of the US is the Skype of the Europe. Like they have their own
Yeah,
games and they have it's the same mentality. Like
right.
initial.
Yeah, I think Nicholas Zenstrom and a lot of the guys who started Atomico came out of that group.
Uh-huh.
Um, but you're right. There were a lot of investors in U.S. venture capital from Asia, particularly a lot of folks in Japan and
Uh-huh.
also in Europe that were looking to the U.S. I think for that type of investment model over the last 5 to 10 years. I think now European investors I think are also putting money into the European ecosystem, and
Yeah.
you do have some fund to fund structures that are powered by I guess well the UK has its own sort of government backed structures, and then the
Uh-huh.
European Monetary Fund I think also does as well.
Yeah.
Um,
EBRD and IFC, without their presence, a lot of the European VCs will not be existing today.
Right. But really outside those areas, it's taken a while. I think in
Uh-huh.
Southeast Asia, you've seen a lot of innovation happening out of Singapore, and then more more recently, I think out of Indonesia and
Yeah.
Vietnam and Thailand, a little less so maybe Philippines and other places.
Mhm.
In India, you've definitely had a huge amount of investment over the last 10 years. But again, most of those ecosystems really didn't start happening until around or after 2010.
Yeah.
Um, so now I think you do have global ecosystems in a bunch of different places, but
Mhm.
outside the U.S., I would say China most prominently, Europe, to some extent, and then to a little bit lesser extent, maybe Southeast Asia and
Uh-huh.
India, although they're certainly growing very quickly. Um, and
And some
then
unicorns in the Middle East.
yeah, yeah. I mean, I think the Middle East has taken a bunch of jumps ahead just in the last few years.
Yeah.
It was really difficult maybe 5 years ago, but now you're seeing some larger
Yeah.
outcomes. I think definitely at least in transportation, the Uber acquisition of Careem, and
Yeah.
in e-commerce,
Amazon.
Amazon's acquisition
So,
of Souk. Yeah, and so. And there were a few others before that, but those are probably the two most notable. And then you've seen very large investments by both Mubadala and the Saudi Private Investment
yep.
Fund in other parts of the world, and then they've used that to start some of their own local market initiatives
Yeah.
as well.
I mean,
So I think gradually, we're seeing a lot more, but it's still been challenging, I think, for local ecosystems to get off the ground. And even in the U.S., I would say
it
that's
is.
still
Yeah.
that's still challenging outside places like Silicon Valley, New York, and L.A. A lot of the stuff you were mentioning with Steve Case, I think, was because outside maybe the top 5 to 10 U.S. metros, there's not very much venture capital availability,
I mean,
even though
even
some
like
of those places are large.
yeah, and even though there are like great university cities like Michigan, they were also having problems without attracting a lot of capital,
Yeah,
and everybody's flocking. But
mhm.
now we are all kind of locked down where we are, and
Yeah,
and before that, actually, recently you were critiquing yourself about like losing your edge because you're getting old and trying to understand the deals return, which I don't agree. Like, if you're getting old, I'm getting old. Let's not get into that. But
yeah,
like the pattern recognition deals, the stuff is like being discussed a lot. Like, of course, when you're looking into this in Silicon Valley, if you're not investing in everything, you're gonna miss out unicorns. But if you
yeah,
are, like at very early stages, there's so many freaking deals going on, and you can't possibly invest in all of them. And I remember the funny story where like
yeah.
uh, Paul Graham was uh, like trying to shove Airbnb out of Fred Wilson. It's like, no, no, I'm never going to invest. And I was very happy to read that as an angel investor. It's like, okay,
Yeah,
if he's missing on that one, I'm not going to blame myself.
I
But you
I
went a
missed on
little
that one
harder.
too. I had the opportunity. I met
Yeah,
Brian Chesky back around 2008, I think, or yeah, it was
yeah.
just as I was joining Founders Fund, and he was pitching cereal boxes at the time.
That's what
That
I was
was
going to
the
ask you. Like, did he bring you cereal
Airbnb.
box?
Yeah, he did. And I wish I'd sort of caught him. If I'd wish I caught him like a few months earlier or later, I probably. But when he showed me the
Without the
cereal
cereal
boxes,
boxes.
I was like, I don't really know about the cereal boxes thing. I guess at the time it was Barack Obama was running against
Yeah, do or die.
John McCain.
McCain,
Yeah, so
Captain
he had two, he
McCain.
had two cereal boxes. One was Obama O's,
Oh my,
and the other
McCain,
one was
Captain Crunch.
McCain Cap'n Crunch or Captain McCain or something. I can't remember. But I wish I'd paid more attention to that deal.
Well, again, like what do you really think that kind of ticks with investors? I mean, you also invested your own money at a
Yeah,
while, like, and you got some hits, and while you were
yeah,
investing your money,
but that
you
took a
missed.
while.
Yeah,
Yeah, yeah, I
well,
definitely. I mean, I famously chose not to invest in Uber in the seed stage, which I wish I'd made a different decision. Uh, I met Travis a couple years before, and I knew he was a pretty amazing entrepreneur. But and Garrett Camp actually was also
yeah.
the person who had started it before
Mhm.
Travis got involved, I think, or I guess they did together. Anyway, we got into a bunch of great deals, but we probably missed two or three for every one that we got into. I think people use the baseball analogy and say, if you're
Home runs.
getting 30% of the unicorns that you see that you invest in, you're probably doing great. But it's always a bit, you kind of obsess over the deals that you don't do more than the ones that you
Yeah,
do. But that was the whole kind of theory and strategy behind 500 startups, was that most things fail, and even the things that succeed are not going to be very large. And so we kind of knew when we started 500. In fact, the name sort of represented the idea that we were going to do a large number of investments. Probably most of them would fail, and hopefully we would find a few.
yeah.
Turns out 10 years later, if we look at our results, probably around 2 to 3% of our investments turned into these IPOs or 50 to 100x outcomes. Maybe in a few
Uh-huh.
funds we even did a little better than
Very
that. I
true.
think
Yeah,
in our first fund, maybe even 5% were in that range. But it's still, most of the companies you invest in are going to fail. Most of the winners are not going to be large.
yeah.
Um, and so we used an approach that we thought was fairly mathematical and quantitative,
Uh-huh.
especially when you're starting at seed or even pre-seed. You have to factor in a level of attrition and time before you see those
Yeah.
successes.
And now, is that why you're kind of getting away from the early stage side and going to the dark side, and like, unless you have $10 million, I'm not gonna see you again. Like,
Yeah, I mean, I think for me, doing early stage investing is still an area that's a passion, but after doing that for the last 10, 15 years, I kind of wanted to do something different. Probably starting really around 2015 at 500 startups, I sort of shifted from doing, a lot of investing to really helping our fund managers get off the ground. So for the first three funds at 500 startups, I did a lot of the fundraising as well as deployment. I probably did 500 companies myself out of that. The first three funds, I think, was about 1,300 investments. I'm pretty sure I did at least 300 or 400 of those,
yeah.
maybe more. But
Some
starting in
on the
fund
dinner
three and fund,
table,
what's that?
some on dinner table or with hookah.
Yes, all the time. I did an investment while I was in an Uber one time in a company. um, yeah, but to me, what was really exciting was trying to help people get their own funds off the
Mhm.
ground, and so I started spending a lot more time helping fund managers get rolling. About 20 different funds within the 500 network that we started between say 2013 and 2017 or 18. And we were also small LPs in about 20 other funds outside 500. Um, so that was really, just a chance to kind of do that work. And I guess like you're mentioning, I was tweeting over the weekend that I felt like I was getting a little out of touch and that I wasn't, you know, I really think venture capital is a younger person's game, and I'm 53 now, so I'm not sure I'm as in touch with everything. It's been 20 years since I've been a programmer, so I'm not really that technical anymore. Um, but I think I've learned a lot about the process of raising a fund and running a fund and making investments. That's probably where I'm enjoying it. So the new company that I'm running, Practical Venture Capital, is really about how to help improve liquidity solutions for LPs and GPs in
Mhm.
funds. But yeah, I don't know. I might still do a little early stage investing, but I think I'll leave that to other folks who are
Are
probably a
you
little sharper than I am these days, who are
are you
doing
personally investing still? Here and there.
occasionally here and there. I will do a little
Don't
bit.
send. Nobody will should send you text.
Please don't
Like,
send me startups.
I
Yeah,
don't want
I
to create a
mean,
thunderstorm here.
Quick
most
question.
of what I do on personal is probably helping fund managers get off the ground.
Yeah. So Burak is here
Yes,
to
my
answer your
question.
questions. Go.
It's my
Sure.
question. I mean, Dave, you have mentioned that you had, 500 startups that you have by yourself invested, and you have, I think, invested more than 2,000 or probably more than that, a number of investments.
The
So you
overall
have,
firm. Yeah.
yes, you have a huge database, which no VCs had these databases earlier. So you know what factors affect the startup's success and fails. Did you ever check the data on that regard to machine learning or deep learning, or did you ever check the variables, which variables affect the success of startups, and
Yeah.
does countries affect the also failure? Did you have availability to do that?
Well, I wish I could say I was more organized and quantitative in looking back at all the deals that we did. I think at this point, 500 has probably done over 2,500 deals.
Yeah.
Y Combinator probably also has done several thousand deals. I think Techstars and maybe SOSV and a few others have large databases to look at like that. Probably AngelList as well. I mean, for us when we were doing it, kind of keeping track of all the deals was maybe the second priority, just making sure that we did them. So I don't know if I have as much of a comprehensive data approach to what worked and what didn't. The other thing is that it still takes a long time to see what actually works. So
Yeah.
a lot of times your feedback loops are 5 years, even 10 years long to understand whether companies have success or not. I think a lot of Paul Graham's initial observations are probably correct, in that the reason most startups fail is usually just because they were building a product for a market where there wasn't any customers. That's usually the primary thing that's going on, is people are building the wrong product,
Yeah.
or they're building for either the wrong market or they're no market. A lot of times people don't really look at the market. They kind of just build a product or solution that they.
Crunchbase did a post-mortem for about over 130 funded startups, and that's like 62% were saying like wrong product or wrong market without much discussion.
Yeah, and I think a lot of Eric Ries lean startup thinking is one of the ways to address some of that is really just to be iterative. I mean, it's not necessarily Eric wasn't the first person to think of that, but I think he was the first person to popularize that approach. Maybe Steve Blank a little bit before him, and if you go back even further, I think Toyota and the Japanese Kaizen manufacturing system. So just really listening to customers and building based on their feedback loops is kind of there's nothing necessarily new about that idea, but for whatever reason, technologists haven't necessarily been great students of that approach. Hopefully over the last 10 years, maybe that started to change now. But even yeah, right, exactly. I think even if you are listening to customers and trying to build for their needs, there's still a whole bunch of other reasons why startups might not work, and ability to raise capital, ability to build a product sort of successfully, being able to scale up your operations and hire the team, being able to iterate somewhat quickly in an environment where there may be changes and competitive pressures. So I think just it's just difficult in general. We aren't really built as human beings necessarily to scale companies up. I think if you look at human civilization and tribe sizes, probably there's some natural limits around 50 to 150 people, where it's hard to build companies that are larger than 100 people, just because you aren't really built as a person to understand how that works. And I can tell you from running a company that was about 100 to 150 people, I started to not be that great after that size. So it's kind of one thing to just be able to get past the product market fit stage and just get a small group of 5 to 10 people to work together. But even if you get that working, getting the capital and the people to build then a 50 to 100 person company, and then beyond that to even scale beyond 100 people, potentially to an IPO size company, that's super difficult. So it's not really surprising that building companies are difficult and unusual. I just think that when we've started to maybe take a little bit more scientific approach to company building in the last decade or so, and a little bit more process oriented on the capital approach, and so I do think if you look at the growth of the accelerator programs, maybe starting as far back as Idea Lab and Bill Gross, but probably more recently, I think Y Combinator Paul Graham was really the person that started a lot of that, and then maybe Techstars and a few others after that. So we're starting to get to a time now where there is more process definition and a little bit more scientific approach, but I would say there's still probably a lot more that we can do to improve the company building process.
And I mean, the question that the part that you said, it's really difficult even for venture capitalists to kind of hit a lot of the success stories. It should also resonate with the startups. Like, the investors don't get it right for many times. And if you're not able to fundraise from 10, 20 VCs, it doesn't mean that you are doing something wrong. You just need to keep on working a little bit more, because at the end of the day, if you only need one investor to believe in you,
Right.
And the VCs have a lot more resources to spend, but they also need to spend it at certain time intervals, which that's not the environment that startups live in. So
yeah. Well, I think these days there's a lot more capital available at seed stage, whether that's through accelerator programs or angel investors or even smaller VC groups. But usually I don't think, outside the US market, maybe it's similar in China, there's not a huge tradition of angel investing in most markets. So you are seeing that start to change, and in the Middle East, there's definitely some folks who are starting to do angel investing more regularly. but they probably come from more traditional business backgrounds, and so it's not always a great match. They may be expecting normal business,
and fast and
business plans and models and accounting, when startups don't really have that type of approach, and usually there's nothing to measure in a lot of cases except your expenses. So I think we have to sort of recreate the environments that we think about, which aren't traditional, stable business model, structures that tend to be unstable and still emerging structures.
But that's became a little bit of your hobby, and now with practical, you're raising, as far as I read, it's not confirmed, but about $100 million to do secondary deals.
Can't really talk about our fundraising efforts because of the SEC restrictions. I guess my response there is we can neither confirm nor deny the existence of our nuclear weapons, but yes. I think what we're really trying to do is help improve liquidity in the overall venture capital market. And in general, we do that by buying out LP interests, the people who invest in VC funds. Sometimes we'll also buy from the general partner side or from the fund manager side. It's a little different than most people's exposure to secondary is through retail platforms, companies like Shares Post or EquityZen or Forge, and maybe now Carta in the future. So there are people who are doing company secondary approaches where people are buying shares in unicorns. We're kind of doing that same approach, but for funds.
Why is this a good time to do this?
Well, we think that there's a strong need for liquidity at any time. For a lot of folks who are investors in funds, they tend to be 10-year vehicles, and really more like 10 to 15-year vehicles. For the most institutional sort of investors in VC funds, they're structured to be patient over that long a time frame. But for a lot of smaller investors, high net worth individuals and family offices and even corporates, maybe that 10-year time frame is long for them. And so a lot of folks, particularly in unstable or uncertain environments like we're going through the last few months, they may want to get capital back out of their investments before the 10-year time frame is up or longer. They may want to redeploy assets into other areas if they're looking to maybe make a large they're looking for real estate investment purchase, or there's a change to their structure. So it's just not a very efficient asset class. If you look at other asset classes in public markets or even other private markets, private equity and hedge funds, there's tends to be more liquidity options after 5 years. So we think eventually over time that will become a more liquid market. But at the moment there's a lot of sellers and not very many buyers. And so it's a good opportunity, I think, to provide liquidity to the market, and hopefully we make some significant returns for our investors because of that inefficiency.
I mean, it seems like you're going to be hitting the same path that you described before, where the valuations are going down in an environment where there's a lot of crisis. You might actually find really at decent price deals with a lot of the micro.
We're seeing discounts as large as 40 to 50%. I think even in normal markets, you would see probably discounts to NAV between 25 to 35%, but in current conditions, probably substantially more than that.
YC just took 12% of the whole startup world valuation by reducing.
What was that?
The YC just reduced their ticket size from 150 to 125, which is
right.
Yeah, so they just wiped out minimum 12% of the startup valuation globally. If YC is cutting that, I'm cutting that.
I don't think. Well, I mean, first of all, we should really observe that YC has done a fantastic job providing capital to the market overall. I mean, Paul, and then Sam and now Michael have done a really fabulous job over the last decade. Actually, probably closer to 15 years at this point. So I don't really feel appropriate to criticize anything that they're doing. I think that they've
without
done a great
YC,
job.
this whole accelerator boom will not have worked I would not have worked in
Yeah.
multiple accelerators if Paul Graham and Jessica haven't launched something called an accelerator.
Yeah.
So.
And I think they also, provided an example for a lot of other people. I think that was certainly what we took a lot of the ideas from YCO at 500 and tried to take some of that around the world internationally. And I do think that people tend to take those initial ideas and they have to change them a little bit when they go around the world to other markets. It's not quite as easy to get downstream capital in other markets as it is in the U.S. and there's not as maybe active an IPO market either. But still, you have a lot more people involved in investing in startups, a lot more startup innovation happening all over the world, which I think is generally a positive. Even if there's been a slight pullback in activity or valuations over the last couple of months, it's still 10 times larger than it was a decade ago.
Absolutely.
Do you think that the current condition about the political situation in the US will affect the talent to come to San Francisco?
Well, I think it's probably going to be a little harder to bring foreign talent from outside the U.S. just because of immigration changes that have happened in the U.S. But that said, I would still say, even though it's challenging, there's still going to be a lot of people wanting to come to the U.S. and assuming they can get into the country. There's quite a bit of innovation that's happening. I mean, I would say probably at least half, if not more than half, of U.S. company startups are started by immigrants, either first or second generation. And I don't think that's going to change, even though the current administration has made that harder. I think that's a terrible decision, but hopefully some of that might get reversed in the future. But I think I was just looking at an AI talent study that showed even though most of the talent in AI comes from other parts of the world, I think it's still probably more than half of it ends up here in the U.S. one way or another. So I think because there's been a strong tradition of innovation coming from immigrants in the U.S. and a lot of capital formation here, it's still an attractive place for a lot of people to come to. But it's also the case that you see a lot more of that happening outside the U.S. as well, and whether that's China or Canada or Europe or Middle East or wherever, I think there's just more happening everywhere. So the U.S. may still be trying to be competitive, and maybe they do better job, maybe they don't do a better job than maybe 4 or 5 years ago, but still, I don't think people are going to stop trying to come to the U.S. tomorrow. Hopefully they do have opportunities outside the U.S. in their local markets as well.
So do you think that this work from home culture, remote work will last? Because I agree that the companies
will last.
The companies, but I don't think people will want to come to US with all this, not just the virus or the political situation, but
there's many reasons why they might want to and many reasons why they might not want to, but the reality is it's probably challenging right now, and at least for the next year I think that will probably be the case. But I think it's also just everybody's had this experiment over the last 3 months in working from home, and I think for a lot of people they realized, hey, it's not that bad. I mean, it's still challenging in many respects, but in terms of getting work done, it's certainly possible. And you have companies like Automatic that provides WordPress, and they've been fully distributed remote ever since their very beginning. So I think a lot more companies have had the chance to experiment with working from home and remote solutions. And it's not easy or perfect in every scenario, but it's probably easier than most people thought. And probably because some of the tools that we now have that we didn't maybe a decade ago, you have a lot of tools like Zoom and Microsoft Teams and Google Hangouts that do make it easy to do what we're doing right now. I mean, this might not have been that easy a decade ago. Certainly not as cheap a decade ago. You have a company like Zoom that scaled up from 10 million users to 200 million users in a matter of months. I mean, that's just unbelievable to see a company do a 20x growth, at that size in just 3-4 months. I mean, people complain or bitch about, the fact Zoom isn't perfect. And I'm like, are you kidding? Like the fact that they've grown 20x and still managed to like basically still operate, without too many hiccups is kind of crazy.
Without a fail-whale logo that needed to emerge.
Right? Right. If you think about Twitter, 10 years ago. Right. So I mean, having platforms like, AWS and others that allow you to do, remote computing, and platforms like Zoom to do collaboration. I mean, it's just really amazing what people can do in a distributed environment these days.
Dave, you're very passionate. What motivates you to wake up in the morning?
Well, I think, these days I'm getting a little older, so I don't wake up quite as fast. It's usually the dog that wakes me up this morning.
I would say the kid or the dog, but like.
Well, the kids are teenagers, so they don't wake me up as much anymore. We have a puppy dog, so I that's usually what I'm waking up for. I mean, I think I'm still excited about the work that I'm doing, even though, now I'm working more with, fund managers and investors instead of entrepreneurs. It's still very interesting. It's still very innovative. Venture capital, even though it's been around for, 60, 70 years at this point, maybe longer, depending on how you count. There's still a lot of things to make better. I mean, so I sort of have a tinkerer's approach in that I think we've, with 500 startups, we tried to figure out one set of things about using a quantitative, large portfolio strategy to improve returns. I think we still realize that liquidity was a challenge for venture capital. So now we're trying to look at how do we improve liquidity. There's definitely all kinds of things to improve, even in our industry. In fact, probably more so in our industry than maybe in the past. Some other folks, I think Naval at AngelList tried to work on. You have the whole fields of crypto and AI and ML kind of opening up. You have still lots of interesting problems to be solved in SaaS and B2B and fintech and in marketplaces. Now you have a really compelling reason to work on healthcare and education. So I think there's just a lot more places where venture capital can be applied. Probably now climate change also is an interesting area to go after. So I mean, I think there's a never-ending source of interesting problems and businesses to be built in technology. It's just maybe the engine of that change isn't maybe perfect, and so trying to figure out how to improve the financial engineering and structure of the venture capital asset class. That's why you're seeing sort of different experiments in how either larger firms or accelerator firms or remote firms or AI assisted investing. There's all kinds of improvements, I think, that can make the overall system work better.
So we have a lot more utopias and dystopias to live through.
Well, there's always going to be ups and downs, and I think that's okay. I mean, we can figure out how to get past that stuff, and this is sort of the third downturn that I've been through, either as an entrepreneur or as an investor. This one's actually been fairly short. I mean, I think the market recovered fairly quickly from the initial downturn. We still have a lot of things to figure out, but I think we'll still be fine.
What are you recently reading, and which books do you recommend, and which books have changed your life? Do you have a kind of milestone books that have already changed your life?
Well, I can't say that I do a lot of long form reading these days. Usually I'm pretty distracted like everybody else. I mostly read blogs and social media platforms. I guess three books that really affected me further back in the past. There's a book called Guns, Germs, and Steel by Jared Diamond that was written about 25 years ago, I think, actually maybe longer. That's really about human civilization and the transition from hunter-gatherer to agrarian societies, and does talk a lot about technology over a 10,000 year period. That's a fascinating book that just talks about all kinds of things: anthropology, biology, linguistics. Really amazing book. Another one for me that was really important was called The Mystery of Capital by an author named De Soto, and it talks about capital formation in markets, around the world, and particularly the property rights and real estate and business formation as a way to improve capital formation. That was really interesting. I read that probably again close to 15 to 20 years ago. I think 20 years ago. I think for folks who are entrepreneurs, I would say probably rather than just reading books, it's probably more, reading blog posts, listening to podcasts, and YouTube. I mean, I guess I say this all the time now, and people kind of think it's silly, but my son does a lot of his education on YouTube. Udemy, which is a company that we invested in, actually started by a Turkish entrepreneur. That was a company we got to invest in very early, and is now huge, doing probably several hundred million in revenue. So I think online video is probably the best teacher in a lot of ways. I mean, I don't want to say people shouldn't read books. I still think that there's a lot you gain from sort of focusing your mind into reading and imagining that's different from the video experience. But still, the availability of YouTube, which is again, this is kind of crazy, but YouTube was started by friends of mine at PayPal that I used to work with. I wish I'd stuck with them and gotten a job there, but I think my first experience with YouTube, I was probably one of the first 100 or so users back in April of 2005. It's just amazing. I still spend tons of time on YouTube and on all kinds of different subjects. I mean, for music, for animation, for watching sports or news, it's a fabulous and incredible resource. I'm sure for a lot of kids these days, they look at other mobile video platforms like TikTok and others, Instagram and Snap as ways.
Yeah, on a good day, I can put my daughter's YouTube consumption under 4 hours.
I mean, there's some downsides to that you have to be careful about. But still, it's just amazing to me how much information is available. Certainly, different from 20, 25 years ago, but even different from like 5 to 10 years ago, the amount of information and accessibility we have around the world. So I think that's a very, I don't know, there's downsides to social media and technology, and I shouldn't just like say everything's perfect and beautiful, and clearly a lot of discussions going on about that now. But still, I think the net, the net benefits are positive, in my opinion.
Dave, thank you very much for this valuable an hour-long fireside chat. I am very excited to host you at Startup Istanbul again, or this time online, and hope to welcome you in Istanbul physically as well. Hopefully,
I hope to make it back here sometime soon. Yeah, I don't know when, but certainly would love to share a drink with you on the Bosporus sometime soon.
Yeah, you should bring the kids next time.
We'll see about that. They may be more interested in playing online video games from the house than getting on a plane right now.
Yeah,
but we'll see. Yeah.
Ozan, thank you very much again. Dave, have a great day over there.
Thank you very much. Hope you guys good luck.
Thank you. Bye.
Best wishes to all the entrepreneurs out there and startup engineers. Everybody, good luck with your projects.
Go build.
All right. Yeah. Right. Go build. Exactly. Take care. Bye-bye.
Bye.
Thank you. Bye-bye.